Well, hello everybody, and welcome to another episode of the Trusted Trustee podcast. And it's the last one for 2025. And as usual, I'm joined by Tracey Besters all the way from the Southern Highlands in New South Wales. New South Wales, I'll put my teeth back in. How are you, Tracey? Great to see you.
I'm doing really well, Darin, and can you believe that we have gone through another 12 months of podcasts? How exciting.
Mm, It's exciting from that point of view, but it certainly makes me feel very old as well, Tracey. So
Hearing
pros
you.
and pros and cons there.
Hmm.
Now, of course, this podcast is brought to you by Superfund Property Valuations. Take the tension out of tax time by making Superfund Property Valuations your number one choice for all your SMSF property valuation requirements. Order a report today by filling in your details online at superfundpropertyvaluations.com.au and let Superfund Property Valuations take care of the hard work. And again, a shout out to the great folk at Superfund Property Valuations. And of course, I think their services will be more sought after when 2026 ticks over with a lot of the changes we're about to see in the superannuation space. But speaking of getting to the end of 2025, today we're going to do something a little bit different, a bit of a year in review wrap, but we're actually going to classify some of the changes that we've seen to the SMSF sector as best or worst changes. You can call them, winners and losers if you like. We'll probably be referring to them in similar fashions as we talk. But some of the better changes, some of the not so good changes, and see where we landed in 2025. So I'm going to kick it off. It wouldn't be a best and worst slash winners losers discussion without talking about Division 296 tax, our old friend that never gets tired. So, Trace, I'm going to say that I think so. Obviously, we've got a revised version of Division 296 now. And I would say uh, I would classify that as both a winner and a loser at the same time. I know I'm getting splinters on my bum because I'm sitting on the fence there, but winner from the point of view that the most egregious um, elements of the policy, the original policy, have been taken out. So that was mainly the taxation of unrealized capital gains and no indexation measure. So they've addressed that. Fantastic. Tick, winner. But a lot of the devil is in the detail, which we haven't seen yet. And, with it will come a lot of additional administration burden. I think we can chalk that one down already. So from that perspective, loser. What do you
Absolutely.
think, Trace?
Oh, look, I agree with you, but I also would add that the loser is the fact that we will have the tax as well.
Oh yeah, of course, of course.
From the very outset, we've been saying that we don't like the tax, we don't want the tax. Obviously, the government haven't listened to us, but they did listen to us in a few ways, didn't they, Darren? Because I remember doing some podcasts during the year, and shortly
Yeah.
thereafter, when we shared our views, Jim Chalmers was listening closely, and he changed some of the things that we didn't like about Div 296. And I think that, big thing is that we're at the end of 2025 as at recording of the podcast, we still don't have the legislation for Div 296. I'm assuming their consultation period has ended. I'm assuming they've done the consultation that they promised, but yet we're yet to see that detail and that devil in the detail, as you mentioned.
Just a quick update on that.
Yeah.
We're not going to see it before Christmas.
Yeah, as we expected.
So it's been delayed. So
Yeah.
we're not going to, there was speculation, just to fill our listeners in, there was speculation that this would drop before Christmas. I cynically said on Christmas Day or
Yeah.
Christmas Eve where they could get away with it, but apparently they haven't even been able to facilitate that. So we won't see the proposed legislation for this revised version of the policy until 2026. However, I think that it will be full pedal to the metal to try and get it through, which means that the first sitting days of Parliament are in February. So just watch that space at the start of next year. And of course, they'll probably try and do it when everybody's still in
Holiday.
post-Christmas slumber and in holiday mode. 100%. You know, we know all their tricks.
Yeah,
But
absolutely.
one item in their kit bag is you can rule out. They're not going to drop it before Christmas.
Yeah.
So there we
And
go.
look,
We can enjoy Christmas. We can enjoy Boxing Day and the Boxing Day Test match because that was around the time that I suspected they were going to do it, but they're not going to do
you thought you'd be watching the Boxing Day Test match with the legislation in hand.
it. Yeah, I don't know whether or not I would have been that keen, but maybe in a lot of ways we can add that to the winner list
There you go.
that we won't have that, you know, inconvenient window to try and address some of this stuff.
Yeah,
Yeah.
exactly. And there's still so much we don't know about Div 296 in terms of, how are we going to assess realized gains? What does that look like? How are we going to get the supporting information that we need in the files to be able to support that? What does our CGT uplift look like? And can we actually apply that across the board? There has been some talk potentially about actuarial certificates being required to justify the valuation piece and the allocation or the proportion of the gains and the income and the earnings to those members with $3 million. Does that mean that if we don't currently need an actuarial certificate for ECPI purposes, do we now have to get one, or should we get one even if they're in accumulation? Look, there's I could rattle on for hours about the things that we don't know. So definitely a winner in the sense of more clarification, more clarity than we
Yeah.
had, and getting rid of the unrealized gains. I think that was the big one.
Yeah, less egregious. And of course, talking about CGT reset, that's where super fund property valuations will have a very busy time because if there is a CGT reset for Div 296, valuation services will be very, very popular. Now we're going to turn our attention to the next subject, and that is non-arm's length income slash non-arm's length expenditure. And
Yeah.
of course, there was a bit of a development there, wasn't there, Tracy?
Yeah, look, we got some more clarification. And, Gnarly seemed to be one of those topics, Darin, that we were talking about for so long, like years. It feels like we've been talking gnarly. And we did get some clarification back in, I think it was September, with the finalisation of a LCR from the ATO. Did give us more clarity, but there's still some unknowns. There's still some things that we need further clarification on. So, there's some things around like the services that people like in our shoes in the accounting space can provide services to our own SMSFs, and what does that look like in terms of how much can we charge, how much can't we charge? I think the big thing that's come out of that LCR for me, Darin, was around there was some footnote clarifications in the LCR and law companion ruling for anyone who doesn't know what LCR means, but it's the way that the ATO apply the rules and the law. And the big one was around even if you've got a service which is providing tax management services or management of tax returns or the application of the tax laws, that's not going to fall under NALI even if you don't charge for that. So that was a big kind of thing that came out of the clarification of the LCR. So, but we still don't know a few things. Hey, Darin.
Yeah, no, like everything, there's a bit of a way to go, but this is an important stepping stone. So I would actually categorize that as a winner or a
Yes.
win for the SMSF community. If nothing else, we've got a little bit more clarity. Tracy, you just mentioned the whole accounting and admin sort of conundrum that people have been facing if they do their own admin and they're an accountant, like a professional accountant. But I think it has provided some clarity over if you provide a service to your fund as a trustee, what you can and what you can't charge for, and how that will be treated in terms of non-arm's length income slash non-arm's length expenditure. And I think there are probably some common sense solutions in there. I know that I'm getting into the weeds a little bit here, but this is some of the sort of confusion around that. I think that they've provided an example where if you if you're working in your office, you're an accountant or you're an auditor or something like that, and you get a phone call from the ATO or something and you answer it and they ask you to provide information for them to process your annual return or whatever it might be. And you use because you're at work, you use your work computer to facilitate that request. And of course, you've used your work phone because you're at work.
Right.
Now,
Yeah.
they've specified that a situation like that will not be considered non-arm's length expenditure or non-arm's length income because you didn't charge the fund back because you've used work resources, which was, I mean, we laugh about this, but seriously, these were the sort of considerations. Whereas, like a big question mark over, well, hell, Tracy, if I do that, like, how far does it extend? Do I have to charge a nominal fee? Some
Yeah.
peace of mind around that, I think, is really good, even though, as I said, there's still a bit of a way to go with rectification of assets that have been identified as attracting the non-arm's length income rules. That
Yeah.
still has to be sorted out and more discussion around that. But what they've done this year, big tip, winner, I say.
I agree with you. And I think so definitely a win for getting that gnarly clarification. Obviously the big thing to go, which is still a loser or a, worst for me, is like you said, if you've got an asset that's tainted by the non-arm's length income, then it could potentially attract non-arm's length income on the capital gain. So that's kind of the big loser or the big worst case scenario that's still sitting within this gnarly environment that we really would like to see resolved and more clarification given on exactly those circumstances.
Yeah, absolutely. So what's the next category you wanna touch on?
Oh, look, I reckon we talk about a bit of a topical one, Darren. I think one of the worst things that we saw this year, which was just behaviour from some people in the industry or one particular person in the industry, was an auditor, and the auditor was struck off back in I think 2024, and basically May 24, I think it was, and continued to keep auditing funds. So he's already been struck off. He appealed, got lost the appeal, and then just kept doing what he's doing. So now the integrity of the whole SMSF space relies upon everyone doing the right thing, right? So if you've been struck off as an auditor and then you keep doing what you shouldn't be doing, like i.e. auditing funds, then it really does put a huge question mark around, well, come on, what's happening with this particular individual?
Yeah, I couldn't agree more, Tracy. And probably one of the more alarming things about this case is that if any practitioners need to be held to a higher standard, it's auditors, because auditors actually, they check the funds and make sure that they're complying. That's their role.
Yeah, they're
If
the
the
keeper.
auditors themselves do the wrong thing, then it's kind of like the whole structure falls down.
Yeah,
Because like the the exam marker
yeah,
then has absolutely no credibility anymore, which means that the whole sector comes into question then, which is absolutely terrible.
yeah.
And again, it's really bad to see individuals behave like this because, okay, so what? You might be doing it for your own gain because you're still receiving fees and whatever.
Yeah.
But obviously, there's no consideration for the macro view of the industry and really how severe the damage can be when just one bad actor does this.
Yeah, exactly, Darren. And kind of obviously I don't know the person like the person involved personally. And you just kind of wonder, is it worth it? With the circumstances and the consequences of this guy's actions could be, very severe for him and very, long-term imprisonment effectively if the laws are applied in that way. And you kind of think, well, is it actually worth it for the fees that would have been generated for the number of audits that were done? So look, it does bring into question the integrity of the system and the sector, and we're all working hard to educate people on how to win in this space and how to get the best out of their SMSF. So it's disappointing to see that sort of
Yeah,
behaviour.
absolutely disappointing. And the thing that I'm always conscious of is that viewers and listeners will know that any given opportunity, the SMSF sector gets attacked
Yeah.
from other sectors in the superannuation industry. And the last thing you want to do is provide them with any ammunition to come back to you. And founded or unfounded, and most of it's unfounded, but they'll just throw bombs anyway. They'll seize on something like this and they'll just throw bombs anyway. And you don't, like, just don't give them the opportunity to do that. I know the individual concerned would not be thinking about that, but this is
No.
potentially why it is so damaging, is because you're just providing opponents opposition to have a go at you. And they'll take it, don't worry.
Absolutely. And talking about throwing bombs, Darin, how was that the CLSR, the Compensation Scheme of Last Resort, little announcement or semi-announcement?
Yeah, look, again, listeners and viewers will not have heard of us talk about the CSLR because up until now, it's been confined to the advisory space. Yes, we do talk about it when we're covering financial advice and, self-managed super stories for financial advisors, accountants, whatever. Now, that's impacted them because there's this massive levy that has been placed on them for the compensation scheme of last resort, which is what this is, and they're having to pay, X million dollars to fund this compensation scheme. Now, and believe me, there's been a lot of uproar about that, but up until now, it's been confined to the advisory space. Well, our good mate Daniel Molino sat down and had a round table, I think it was last week,
Yeah.
with stakeholders in the industry. And guess what he did? As you said, he lobbed a grenade into the whole process, didn't he? And
Mm.
suggested that, oh, well, maybe we shouldn't just confine it to advisors to pay this levy. I'll tell you what, let's include superannuation funds as well. And his initial thought was industry funds and retail funds, so public funds, what we call APRA regulated funds. And of course, as I said about the ammunition of attacking the SMSF sector, well, they're not going to lie down and take that. So the response was, okay, well, if you're going to go us, why aren't you going the SMSS as well? And of course, the response was, oh yeah, that's not a bad consideration. Now it hasn't progressed beyond that,
No.
but that could be the biggest loser of all if that comes in, because it would be asking SMSF trustees to pay for money lost for the collapse of products, financial products. Nothing to
Yeah.
do with, I would even argue, nothing to do with advisors. And I would actually say, forget about the SMSF sector, no superannuant, no super fund should be asked to fund this. But
No.
what's it got to do with them? Unless a specific trustee has got a link to say that, well, they deliberately encourage people to invest in those failed products. Yes, I think then they've got that fund and those people have got a case to answer.
Sure.
You can't just penalise. Like, I'm an SMSF trustee. What the hell has it got to do with me? I didn't invest in that. And it's your
Yeah.
own choice.
Yeah.
It's terrible. I'm not suggesting a financial collapse is good. And
Yeah.
I feel for the people who have lost their money. But
Yeah.
there's got to be some realistic expectation as to who pays for the compensation. I would actually suggest it's the government's responsibility. Don't,
100%.
but we know what this is, Tracey. They see the trillion. I can't remember the exact number of trillion in super now, but they see that and they think, oh, there's a little pot of gold that might help us out.
It
The
won't take
worst,
much from every SMSF or every superannuation fund to be able to fund a little bit more. And I
yeah,
think what was the shortfall, Darren? About 120 mil or something per
yeah,
year?
yeah, yeah. And that is, I think the shortfall is 120 million or something around that figure. The levy for the 26-27 year that they announced not so long ago for advisors was a 82% increase from the year before. Now, how is that sustainable for any business? I mean, come on. If you're a small business, you have an 82% drop in revenue, you're out of business.
Yeah,
You're out of
absolutely.
business,
Yeah.
right?
And so
So,
therefore those
so
fees are passed on. Mm.
yeah.
Mm.
So imposing that cost is just ridiculous. Now, I don't know whether or not it gets worse, if you can believe this. It gets worse because there are two major product collapses that have been in the news quite a lot in the last 6 months, and that is the Shield Master Trust and the First Guardian Master Trust. Both collapsed, both have resulted in investors losing a lot of money. Up until now, the levies and this whole talk about how the compensation scheme of last resort will work in obviously providing some of them recompense with their loss, those two collapses haven't been taken into account in the scheme yet. So
Mm.
where are we headed with this? I don't know. Um,
Certainly going to be much bigger than an 82% increase, though, once those.
100% Tracy, and that could be the biggest loser of all, I
Yeah.
think. Not just for SMSFs, of course, for SMSFs if they're included in it, but for superannuants in general.
Yeah. And I think anytime the government, Darin, want to look at the superannuation sector as a whole, not just the SMSF space, and say, oh, there's money available there to fund things, that is definitely going to get a massive loser status in my mind. It's not fair. Can't happen.
Well, of course not, because if you even propose that, you're
Mm.
starting with the premise that you're not actually recognizing it's it's members' money.
Yeah.
So it's not up to you to get your hands on. You forced us. You forced us to
Yeah.
make those savings. That doesn't mean it's yours. And anybody who's in charge of retirement savings, superannuation benefits, you're just a custodian.
Yeah.
That's it. That's your right. You're just a custodian. Nothing more, nothing less. You'll hang on to my money until I can get my hands on it.
Yeah.
End
Yeah.
of story. So thinking that, oh, hang on, here's a little pot of gold that we can. No, 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 no.
No.
And
And it's this. Sorry. No, go.
the fact that Molino would even consider that, I think, is a real danger sign for all of us.
Yeah.
Because
Exactly.
if a thought bubble like that can come out and he can make an announcement on that round during that round table to say that, oh, why not superannuation funds to fund the CSLR? Well, no, Minister, that's not how it works. And I've just written an editorial about this. As you can tell, I'm pretty fired up about it. But what annoys me is that, just when everything calms down a little bit with Division 296 and we want equality in the sector and the different types of funds to be treated equally, well, bang, there you go.
Yeah.
Reignite the wars between the different sectors. Well done. Well done. Outstanding effort.
It's just ridiculous, Darren. And it's this constant tinkering of the superannuation industry and the constant kind of, oh, let's just change this and do this and do this. That everyone goes, well, this is ridiculous. We cannot trust what the government is going to do with our money. And therefore, why do we want to be within that environment? Let's just not be a part of that environment, get our money out. And
Yeah,
that doesn't help anyone because the whole purpose of superannuation in the beginning was to be able to provide this retirement benefits for people and less reliance upon the government in
yeah,
retirement. So yeah,
yeah.
the constant tinkering just does our head in and obviously fires some of us up.
Yeah. Yes, it does indeed. Well, I'll get off that topic now.
One of the losers and the worst for the year,
Oh yeah,
absolutely.
in my book, that's the biggest loser. If that comes in, that will no doubt, it's already a big loser, I think, flagged by
Mm,
Molino opening his mouth and even suggesting that.
yeah.
But if it does come to fruition, biggest, that could be the biggest loser of the millennium in my book. It's
I was going to say decade, but you're right. Millennium is probably
I'm talking millennium here. Forget about 2025. Yeah, I'm talking millennium here. But anyway, I'll get off my high horse. We'll move on to another topic.
true.
What's happening with the wholesale investor thing? Tracy. This has
Uh,
been running for the entirety of this year.
yeah, I'm gonna hospital pass that back to you, Darren, because I haven't really paid a whole lot of attention to wholesale investors. So I'm gonna throw that back to you and get you to update our listeners on that one.
So basically what happened is that SMSF members have kind of been caught now between a rock and a hard place simply because there are two different criteria that you can use to prove that you're a wholesale investor. And of course, that gives you access to a lot more investment opportunities from fund managers than you normally would if you're just a normal retail investor. Now, one of them, I'm not going to go into the details. One of them is a $10 million asset threshold that you have to satisfy. And another lesser threshold is I think it's a $2.5 million threshold, but you also have to get an accountant's certificate to verify that you can be considered a sophisticated or a wholesale investor. Now, technically speaking, the legislation does spell out that if investments have anything to do with the super fund, you must be regarded initially as a retail investor, or if you are going to be treated as a wholesale investor, you must satisfy the $10 million threshold.
Mhm.
But there's a difference between the static and the working model. Uh, it's kind of been accepted that, yeah, SMSS can use that too. They're probably not supposed to, but we'll just turn a bit of a blind eye to it. And yeah, you can go. That's fine. You can go and do that. Well, unfortunately, um, yeah, the Financial Complaints Authority, sorry, I drew a mental blank there, AFCA, the Australian Financial Complaints Authority, had a case brought to them on this score, and they applied the $10 million threshold to that case. That's got
Mm.
everybody running scared because it's like, well, hell, if I've used this, like where's that leave me? Like, what do I
Mm.
do? I'm already invested as a wholesale investor. Don't tell me I've done the wrong thing. And that is, as I said, they're kind of in a regulatory sandwich, as I'd like to put it, that one government body has applied the rule like this,
Yeah.
and they're quite entitled to do so because it's a strict interpretation of the legislation. Another regulatory body has recognized that it's not really quite the right thing to do to apply the lower threshold, but we're not going to police it, so that's
Yeah.
okay. But, you know, AFCA's ruling has got everybody running scared a little bit in
Yeah.
a state of confusion more, I would say.
Yeah. And I think
No
just
development on
yeah.
this before yet.
I think to clarify for some of the listeners though, Darren, isn't it just if you are a wholesale investor and not a retail investor, then you don't have the same protections
Yes, of
available
course.
to you. So you can't go to AFCA, for example, and make that complaint and hope to get some sort of compensation if you're a wholesale investor. So if the wholesale investor rules have been applied, and in fact you should have been a retail investor, then it does kind of bring into confusion or to some confusion around, well, what are your protection mechanisms?
Yeah, and that case was exactly about that. I used the lower threshold.
Mm.
I got into these sophisticated products, which the individual actually said that they understood. Like
Right.
they did have their head around that sort of stuff. But I lost money, and guess what? I probably shouldn't have been included in that category of investors. So
I want the
I
money.
want some compensation. And we all know that when people lose money, they're not going to accept it themselves.
No, of course, it's
They'll
someone
they'll
else's
look to
fault.
see whether or not I can get some sort of compensation from somebody. And this is where it comes in. So I would say that decision has been a real loser
Yeah.
for self-managed super funds, but
Yeah.
not knowing where this is going to fall, whether or not they'll draw a line in the sand and say, okay,
Yeah.
from this point in time it was all right, but from here on in we'll do this. I think they're going to have to come up with a sensible solution. I know the SMSF Association is doing some work on this right now, but there have been no developments. And that was actually flagged in February at the SMSF Association National Conference for 2025, and we haven't heard any development since then.
10
So
months down. Mm.
who knows? At the moment, though, initially the situation loser for me for SMSS.
Yeah, that makes sense. That makes sense. What about payday super, Darren? What do you think
Payday
payday?
super. Well, I don't think I actually agree in principle with payday super.
Yeah, I
You know,
agree.
I think that obviously if you if you address the disconnect between paying your salaries and then paying the super component of your salaries, it will work better towards late payments, no payments, lost payments,
Yes,
because you'll have that immediacy, and with immediacy comes immediacy of action. As
yes,
in, if I have the wrong details, let me sort it out right now, rather than I pay on a quarterly basis.
yeah,
Sorry, what happened 3 months ago?
yeah,
What was the hold up here? That's a realistic thing. So
yeah.
I think from that perspective, I give it a winner.
Yeah, I agree with you, Darren, and I totally agree with the concept of payday super. I'm glad that it's finally we've got some certainty around it in terms of start dates. Again, the implementation of it and the practical component is going to be a bit difficult for some small businesses and some superannuation funds, let's be honest, around accepting those contributions and not just accepting the contributions though, Darren. I think the issue for me is what happens when it goes wrong in that 7 days period, because you've got 7 days effectively to have made
Yeah,
the contribution and the
yeah,
contribution to be accepted by the fund. What if it's wrong? What happens from an SMSF perspective? Probably not so much of an issue because you would hope that the SMSF members and trustees kind of know their details. You would hope that they know that they've selected this particular fund and all that sort of stuff. But from a practical implementation for some of the bigger funds, I think that there's a lot of work that they still have to do, and they've got a very short period of time to do it in. So, I think that the practical side of it's going to be a bit tough.
yeah. Implementation, the details that we know right now, I would mark loser, not
Yeah,
necessarily for SMSS, but for the superannuation system in general, particularly for small businesses
yeah,
and small employers, because the government, in their wisdom, has scrapped the clearinghouses that are being used at the moment, and you're going to have to sign up to a new clearinghouse to do that. Now, I think the most unfair aspect of this is that you can process your pays, you can do your superannuation component of it, you can hit the button and send it to your clearinghouse,
yeah.
but you remain responsible until those monies hit the individual superannuation accounts.
Yes.
So I don't know if there's an outage at the clearinghouse and they can't do the process within the required 3 days, I think it might be, and those monies don't hit people's superannuation accounts in that period of time. Guess who's on the hook for it? It's not the clearinghouse, it's the employer. So there's a lot,
So the
and
money come out of your bank account, you're still on the hook.
yeah, yeah, 100%. And also, I think there needs to be more consideration taken to an adjustment period.
Yes.
Small businesses, I can stick up my hand as being in this group. You're going to have to do quite a lot of rejigging of your cash flow requirements. And that's not an easy thing to do necessarily. So some sort of transition or sensible transition period would be good to eventually bring it into line, but it can't surely have the severity of one day you're allowed to do this, like pay on a quarterly, but and then the next day it's just, you know, we've brought the shutters down and you're going to do it from here. So I can see a lot of issues with implementation. I give that a cross or a loser.
Yeah.
Idea and concept winner, application loser.
So yeah, and I think that first quarter of July, the July to September quarter is going to be the biggest challenge, isn't it? Because you've still got up until June, as far as I understand it, you can still do the quarterly. So
Yes,
that would be due 28th of July. But then from 1 July, you've then got to do superannuation on a payday
yes,
aspect. So if you pay
yes.
weekly, then you're going to be doing double contributions in July period, one for the quarter of June and then for your weekly payroll in July. So, yeah, I absolutely agree with you on the winner and loser aspect of that. I think we should finish on a positive though. don't you think?
Absolutely.
Honest. You know,
Absolutely.
2025, we're about to launch into the Christmas period. So for me, one of the big wins for this year was still just the confidence that people have in the SMSF sector. And we saw something like 31,000 new SMSFs established. We're at $1.051 billion, trillion dollars, I should say, at 30 June 2025. Superannuation for SMSFs make up 24% of the whole superannuation industry. It's still a growing industry. People have confidence in the industry, and that is exciting to me. So that's a big win from my perspective.
Yep, I concur with that, Tracy. I think the SMSF space, regardless of obviously some of the issues that we still have to address, on
Yeah.
the whole, is in a very good position. And I can actually see it only getting better in a lot of ways. I know that you mentioned in our pre-podcast discussions that self-managed super funds are the only superannuation vehicle where you can really effectively invest in digital assets and crypto.
Yeah.
And let's face it, that is not going away.
No,
You,
definitely not.
you may like to reject the notion of cryptocurrency and Bitcoin and all of that. I can tell you what, it's not going away anytime soon.
No,
So if we can figure out how to manage it properly and use the SMSF structure in a positive sense,
yes,
to be able to include, additional asset classes that provide more portfolio diversity, if
yes,
you include it with other assets, then I think that's a good thing. And I think that's a lot of upside for the SMSF sector and a
absolutely.
really positive development that has probably gained acceleration towards the back end of the year.
Yeah, I would agree with that, Darren. And I think there was an article that you wrote in October actually around the impact of the investor study that I think it was BTC that put out, and there was an increase of 69% year on year of registrations on their platform from SMSF. So huge amount of demand and growth from the SMSF sector into crypto. And yeah, I agree. It's not going to go away anytime soon. And I think that the SMSF industry accepting that as a digital as a class, an investment class, and providing product and services to be able to suit that particular need and desire from SMSF members and trustees can only be a good thing.
Yeah, and one of the good things about that, I'm glad you raised that. One of the interesting aspects I found that study revealed was that it's not just young people who are showing interest in crypto. There are a lot of the older demographic who were wanting to dip their toe in the water and find out more about it and hopefully include it in their fund. So this is a whole of SMSF thing. It's not just oh yeah, of course 18-year-olds would be interested in that. No, 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 no. This is an entire landscape phenomenon here. And yep, hopefully it goes well and it will be a positive working into the future.
Yes, yes. So I'm excited about 2026, Darren, in the SMSF space. I think that there's a lot of good things happening and looking forward to further clarification, we should say, around Div 296, NALI, the compensation scheme of last resort, all of those things that we've said are W's or sorry, losers or worst. We would like to have those on the winner side when we do this again at the end of next year.
Yeah, absolutely. A lot to work through, as you can probably tell, but overall, a big positive year for the SMSF sector. And that's probably not a bad note to end on, Tracy. So, thank you very much for joining me again today.
Pleasure, pleasure. And to all of our listeners, have a wonderful festive season with your families. Stay safe and look after each other. And we'll see you in 2026.
Absolutely. As usual, I'd also like to thank my production team for putting these podcasts together and making sure that they're uploaded onto all of the mediums that we distribute this content on. I'd like to echo Tracy's sentiments and wish everybody a Merry Christmas and a Happy New Year, and for them to enjoy a safe holiday period. Of course, thanks to Superfund Property Valuations for their continued support of these podcasts. Most of all, thank you to everybody out there who's listening/watching this podcast, these podcasts, We hope you're enjoying them. We hope you're getting a lot of information out of them. And we hope you're having fun listening to them as much as we have fun bringing them to you. So until then, we will see you in 2026, and we're very much looking forward to it. Until then, travel safely and have a great day.
Bye for now.